Welcome to this webinar. So we're going to present a presentation that is part of the EDHEC Scientific Beta Research Chair. The title is Sustainable Investing with ESG Rating Uncertainty. And so before starting with the actual research presentation, let me just provide a brief introduction to the research chair. So the EDHEC Scientific Beta Research Chair really has a pretty straightforward objective. So if you think about problems that society faces, quite often you hear the claim that we should listen to the science. Okay, so you hear that when it comes to how should we tackle climate change, how should we deal with the spread of viral disease. In all of these questions, we have to make decisions, and it's good to inform these decisions from scientific evidence. And so when it comes to investment decisions, the same really is true. We should think about what does the evidence tell us, and what are the recommendations and implications from scientifically rigorous approaches. And so the objective of the research chair is really to contribute to a better understanding of what actually evidence and theory tells us about ESG investing and also factor investing. And so we hope to provide some new insights for the investment industry through that. And obviously, we're also hoping that we can learn from this research as an index provider, as Scientific Beta. So today, we're looking at a topic which is ESG investing. And this in particular is related to a research question which we are trying to address with the research chair, which is the ESG premium. So there are several questions that we're trying to address through the research chair. The ESG premium is one of them. And the approach of the chair is really to rely on expertise within EDHEC faculty, as well as Scientific Beta researchers. But we're also seeking contributions from outside faculty. So we also have external contributors to the research chair. So Abraham Leoui, who is the main presenter today, is a professor of finance at EDHEC Business School, and he has been actually conducting the research effort of the research chair on this question of the ESG premium. And so Abraham had already produced working papers in the past, which are available in other publications. And so today is really the latest publication that he has been working on with his co-authors, which is on the particular question of uncertainty of ESG ratings and the implication that uncertainty has on asset prices and on investors. So with that, I will hand over to Abraham for the presentation. Thank you.
Thank you very much, Felix. So this presentation is about sustainable investing with ESG rating uncertainty. So this is a joint project with Doron, C, and Andrea. I will start by providing you some background on how we came to this project, to this idea. Then I'll provide you a quick wrap-up of what are our contributions, both theoretically and empirically. And finally, I will provide you some figures to quantify the phenomenon that we are looking at in this paper. So let's start, please, by the background for this paper. So the first component of this set of events that made us think and try to provide an answer to the role of ESG uncertainty is obviously the interest in ESG investing, and most importantly, the surge in interest in ESG investing. So for us, it looks like ESG has always been important for everyone forever. That's not exactly true. People did care about ESG, but in the last 4, 5, 6 years, we do observe a surge in interest with a drop during the COVID and a recovery since the COVID. But when you look at this figure, for example, it gives you from Google Trends the frequency and the importance of the search for the word ESG and ESG investing. Okay, it was pretty flat. And ESG investing was even zero in the beginning of the 2000. And then since 2014-15, we do see the surge in this. And today you cannot speak to the asset management industry without having something to say about ESG. So this is a broad search just to give you a sense of how important is this concept of ESG and ESG investing. When we look at the newspapers, which is more specialized audience, this curve provide you exactly the same picture from newspapers. Okay, so we looked at all the words related to ESG, ESG investing, sustainable investment, corporate social responsibility, etc. And as you can see there also in the newspapers, we do see, which is specialized and popular, we do see a surge in the interest about ESG and ESG investing. Okay, so this is the first thing that made us think that there is maybe something to do there. The second source of motivation and inspiration for this project came also from the shift to ESG investing. So obviously, the asset management industry, if people care about ESG, they have to provide product either as opportunistic business people or just as a reasonable economic agent. They have to provide products that fit with the test of the population at some point in time. Okay, and needless to tell you, the statistics that we see every day, every week, every month, that the fund flows, whether in the active management industry or in the passive management industry, ETFs, just skyrocket every day more and more to this kind of investment vehicles. Okay, but when we look at the academic evidence, it is less clear-cut than what we see as to the trend from people caring about ESG and the trend from the asset management industry providing products which are ESG, let's call it ESG friendly. When you look at the academic evidence, what you see is that you have two kinds of clear-cut consensus. One consensus is that theoretically, there should be a negative relationship between ESG rating and the alpha. Why? Because when people look at ESG, they do value the non-pecuniary benefit from holding green stocks. As such, at equilibrium, they will be willing to forgive part of the financial performance. Okay? So green stock, non-pecuniary benefit, okay, lower return, negative alpha. All the theoretical papers will deliver exactly this finding. Clear-cut. Even the last two papers by the Chicago, Wharton, and NYU guys in GFE 2021 says exactly this. However, when you look at the empirical evidence, at best, we do observe mixed evidence. So far you have 3, 4, 5 meta-analyses of thousands of papers that have looked at the interaction between ESG and financial performance. And these papers, they do not reach a clear-cut consensus of a positive or a negative relationship. And this is where started our curiosity to understand why. Why is theory so clear about what we should observe in the data, and what we observe in the data is orthogonal to what the theory is telling us? And then we came to another source of motivation for this paper, which is the ESG data problem. Okay, so the ESG data problem stems from the following thing. When you look at the ESG data providers, some paper identify close to 70 data providers, but we have 7, 8 big data providers. There have been some consolidation in the industry recently, but you have 7 or 8 big data providers. And when you look at the ratings of the data provider, what is surprising is that they rarely agree on the rate of each individual firm. Let me make this point concrete by the following figure. Okay, the source of this figure is on the bottom of, it's not our figure, okay? I will give you some numbers from our own study, but this is not from our paper. But this figure takes the ratings from 2 data vendors, MSCI and Refinitiv's, ex-Thomson Reuters, okay? And on the x-axis, you have the rating between 0 and 100 of one data vendor. And on the horizontal, on the vertical axis, you have the rating of the other data vendor. If there was a consensus and the agreement was quite large between the 2 data vendors, all the points should be around the 45-degree line, which is not exactly what you observe in this figure. To get the sense of the disagreement, look at the extreme. when horizontally you are at 0, vertically you are between 20 and 80. That means that when one agency gives a rate of 0 to a company, the other agency could have given a rate between 20 and 80, that is even rating this company among the top company. In the other extreme, when the horizontal firm was giving 100, that is the maximum rating, the other agency would have given a rate between 30 and 100. Okay? So there is a huge disagreement between these two data providers about the rating of the firms. Zooming on particular firms, like for example, the usual suspect, let's say the GAFA, Apple, Microsoft, Amazon. As you can see, for example, for Apple, when you look at the ESG rating of Apple, top left panel of this figure, you see that the ESG rating of Apple goes from very bad to very good. Here, you are reported the ratings of 4 data vendors. Okay? From our own computations, we observe very low correlation between the ratings of all the data vendors. So, what do we have? A surge of interest in ESG, check. A surge in shift in the investment industry from investment to socially responsible investment, check. But then we have a problem. How can you do socially responsible investment if you don't know how to identify socially responsible firms? You can tell, but I have data providers, but they disagree. Okay, so this is where we said maybe this disagreement among data vendors, disagreement about the rating, the ESG rating of firms, may be the source of confusion that explains the dichotomy between the theoretical prediction and the empirical findings. That's exactly what this paper is about. This paper would like to look at the implications theoretically and then test them empirically of what? Of the uncertainty about the ESG profile of firms, okay, and the market outcome of this uncertainty. What are our theoretical findings? Our theoretical findings, when there is no uncertainty about ESG, are perfectly consistent with the state of the art. There should be a negative relationship between ESG and alpha. That is, green stocks should command a negative alpha. Okay? In simple terms, that means that the cost of capital for a green firm relative to a brown firm should be lower. Okay? However, when we introduce ESG uncertainty, this is no longer true. What we remark is that ESG uncertainty is perceived as if the market was riskier. But then, if the market is perceived as riskier, automatically you should create a new risk premium. The new risk premium related to this ESG uncertainty. And this already shows you the mechanism that can blur the relationship between ESG and market and financial performance. ESG rating reduces the required return. ESG uncertainty increases the required market financial return, which means that we have two opposite mechanisms that are at play, the rating and the uncertainty, and in fine, they may offset each other, and this may exactly be the source of the mixed findings that we see in the practice, in the empirical findings. Okay, so, and also, we try in our theoretical derivations, not only we looked at the aggregate market, high uncertainty, high perceived risk, high risk premium, we looked also at the cross-section, green stocks versus brown stocks, and we were able to show that ESG uncertainty may impact the perceived systematic riskiness of the stocks, and as such, generate an additional risk premium absent when you ignore the ESG uncertainty. Okay, so to wrap up, our theoretical findings are high uncertainty, high perceived riskiness, hence high risk premium. Okay, this is true, of course, for brown and green stocks. Green stocks will have an opposite effect to this high risk premium through the positive rating, but in brown stocks which also feature ESG uncertainty in general will have both effects going in the same direction. In green stocks, both effects go in opposite direction. What do we find empirically? Empirically, we could find reasonable support to our predictions. At the aggregate level, we do show that high ESG uncertainty predict high market return. We also find, and this is something I didn't talk about, but it is quite intuitive, if the perceived riskiness of the stock is higher, automatically the demand for this stock from risk-averse investor will be reduced. That's exactly what we find at the aggregate market level. So high risk premium due to high ESG uncertainty, as well as lower market participation. In the cross-section, we do find that the negative relation between ESG and alpha is there, but when you condition on uncertainty, that is, stocks with low ESG uncertainty do deliver exactly what Terry was saying. That is, brown stock should outperform green stocks. However, in the high uncertainty buckets, we cannot distinguish between high and low ESG stocks. Okay, so roughly it confirms the predictions of the model. Now, I would like to show you a few empirical findings just to put numbers on this mechanism that I have been highlighting. First of all, a few words on the data that we are using in this work. So we are using data from 6 data vendors, okay? Asset 4, Thomson Reuters, Refinitiv, so Refinitiv is no longer with Thomson Reuters, but at the time we started working, it was with Thomson Reuters. MSCI, as you know, MSCI has both KLD and IVA, and now MSCI just focus on the IVA methodology, but we do have the 2 data sources, Bloomberg, Sustainalytics, and Robeco. Okay, so we take these 6 data vendors, we combine this with data from, we are focusing on the US, by the way. We are focusing on the US, so we take the corresponding financial information and accounting information from CRIS, and we also use the institutional holding from Thomson Reuters 13F. Institutional holding is our proxy for the demand. And remember, high uncertainty, high perceived risk, and therefore low demand. To test this, we are using the institutional equity holding. So our database is the following one. It's typical in this literature. The coverage varies as time passes. MSCI KLD starts in 19, but since we are after uncertainty, we started in 2002, where Asset 4 starts, okay? And then, as you can see, the coverage for each data vendor increased steadily up to 2019, where our sample ends. And when you look at the number of stocks covered by 1, 2, 3, 4, and 5 data vendors, I'm sorry, there is a problem with the table here for the formatting, but if you look at the very last column, you will see that the number of stocks covered by at least 2 data vendors was roughly 2,000 since 2010, okay? So the sample for the last 10 years, 2,000 stocks were covered by at least 2 data vendors, so we have a fairly reasonable database to address the question we wanted to address. A simple substat from this data, we took stocks, we sorted them according to their ESG rating, where the ESG rating is measured as the average across data vendors, and their ESG uncertainty measured as the pairwise standard deviation between data vendors. And this is a very simple equally weighted return of portfolios in each bucket. So vertically, you have the ESG uncertainty buckets, and horizontally, you have the ESG rating buckets. Okay, and this table already contains the main message of our paper. When you look at the low rating column, the low ESG uncertainty column, you see that low rating stocks equally weighted return was 1.117% per month. And for the highly rated stocks, it was 0.664% on a monthly basis. So you see, when you sit in the low uncertainty bucket, you do observe the negative relation between return and ESG rating. This is exactly the green premium around 50 basis points. Obviously, we haven't done value weighted, small cap, and controlling for the market extra, but it's already a very nice initial evidence that the prediction of the model may be interesting. Because when you look at the high uncertainty bucket on the right column, okay, you see that you can hardly distinguish the average return of low-rated stocks versus high-rated stocks. Okay, so let me please move now to show you some quantitative evidence on the predictions of the model. The model has two main predictions: high uncertainty, high riskiness, low demand. The second prediction is high uncertainty, high riskiness, higher return. Now I show you evidence about the first prediction: high ESG uncertainty, high perceived riskiness, low demand. So we took the stocks in our universe, okay, and we looked at the average quarterly institutional or ownership for these stocks, okay? It's a very important indicator in the literature, okay? And it helps assess how attractive are these stocks from the institutional standpoint. Again, we sorted stocks according to their ESG rating and ESG uncertainty. When you look at the very last, the last line, high ESG rating, you see that for the low ESG uncertainty bucket, the institutional ownership is 73%. When you move to the high uncertainty, now the institutional ownership is only 64.7%. Hence a spread of 8.4%. Negative and statistically significant. This means that for highly rated stocks, for the same level of ESG rating, stocks with high uncertainty experience a lower institutional ownership, lower by how much? By 8.4%. When you look at the low ESG universe, exactly the same picture emerges, even though the phenomenon is not as pronounced. Still, you see that high uncertainty lead to a lower demand of 5.1%. Okay? So green stocks experience 8.4% lower institutional ownership, and brown stocks experience 5.1% lower institutional ownership. Obviously, ownership depends on other characteristics and market phenomena. So we also looked at the ESG, the relationship between ESG uncertainty and institutional ownership at the aggregate. Okay? We computed an aggregate institutional ownership by evaluating the ownership of each individual stock. At the aggregate market level, which allows us to control for many things, for market conditions such as, for example, the default spread related to the distress, the VIX, which is related to fairness, etc. We observe a negative relationship between institutional ownership and ESG uncertainty. More precisely, when you look at the bottom of the slide, we find a 6%, which interestingly is in the middle between 5 and 8. Okay? So that is, at the aggregate market level, ESG uncertainty reduces market participation or institutional ownership by 6%. Okay? The first conjecture of the model that ESG uncertainty is perceived as more riskiness and hence should reduce the demand is confirmed. empirically. Okay? The next evidence I would like to show you is how ESG uncertainty can help us understand the relationship between alpha and ESG. Okay? So without any massaging, I present you here the value-weighted return of portfolio of stocks sorted on ESG rating and ESG uncertainty. Okay? So again, here you have exactly the same picture as I showed you in the summary statistic, but here we are immune to the small cap critique, because we know that small cap are very complicated to trade, and many anomalies that we observe in the markets are driven by small cap, hence not necessarily exploitable. Here we are doing value weighting. Okay? So let's look at low ESG uncertainty stocks. This is the first column of this table. In the first column of this table, as you can see, low ESG rating stocks that we can call brown stocks have an average return of 1.235% on a monthly basis. Highly rated stocks have an average return of 0.642%. And the spread between brown and green is 0.594, which is roughly 60 basis points on a monthly basis. So you see, when you sit in the the low ESG uncertainty bucket, you exactly document the prediction of the existing theory so far. There should be a negative relation between ESG rating and return. However, when you go to the high uncertainty bucket, this spread is no longer statistically significant. First of all, in terms of magnitude, it is 5 times in absolute value lower, and it is not statistically significant. That's exactly our point. If you look at the very last column, where you do not condition on ESG uncertainty, you see that low ESG rated 0.923, high rated 0.805, and the spread is not statistically significant. So the state of the literature is the last column of this table. That is, we cannot distinguish an overperformance or underperformance of green stocks versus brown stocks when you do not condition on ESG uncertainty. However, when you condition on ESG uncertainty, you do observe the significant spread between green and brown in the low ESG uncertainty bucket, and this significance disappears when you move to the high uncertainty bucket. Okay? Now, when you look at the very last line of this table, you see another interesting phenomenon, which is not statistically significant, but you will see it will become shortly. If high ESG uncertainty leads to high perceived riskiness, we should observe that stocks with high ESG uncertainty outperform stocks with low ESG uncertainty without conditioning on ESG rating. That's exactly what we see. Low ESG uncertainty stocks without conditioning on ESG rating win 0.753% on a monthly basis, while high ESG uncertainty stocks win 0.940% on a monthly basis. Here, the spread is pretty substantial, close to 20 basis points on a monthly basis. It's not negligible, but we are borderline in terms of statistical significance. Hopefully, the picture becomes even clearer when you move to controlling for usual systematic sources of risk that we know. So here I show you the table where, instead of looking at the raw value-weighted returns, we are looking at the market, the CAPM alpha. But you have the same exercise about other factor models like the Pharma French 3-factor model augmented with the momentum factor, as well as the Pharma French 5-factor augmented with the momentum. This finding is pretty stable, whatever factor model you use to control for risk. What we observe, now we are speaking about alphas, what you see is that I look at the line low minus high, where it is highlighted in yellow. The alpha of the long-short portfolio, long brown stocks and short green stocks, has an alpha of 0.398, close to 40 basis points. That means brown stocks outperform green stocks by 40 basis points. Exactly the prediction of theory before our theory. That is, when there is no ESG uncertainty, that you are certain about the ESG profile of the firm. However, when you move to the high ESG uncertainty, you see that the alpha is minus 0.10, but most importantly, it is not statistically significant, which means that we cannot document a significant spread between brown stocks and green stocks. The bottom, the last line of this table also shows you the ESG uncertainty premium. The ESG uncertainty premium is of 0.226%, 20 basis points. So it confirms our idea in the theoretical derivations that ESG uncertainty increases the perceived riskiness. Hence, it commands a risk premium, and therefore, it will be a barrier to socially responsible investing. Okay? Now, this table and the previous one do not control for other characteristics. We do control when we do a multi-factor model like Pharma French or whatever, but we know that controlling for factors and controlling characteristics doesn't lead at all to the same findings. So we repeated exactly this table, but by controlling for some characteristics that we know are relevant for stock returns, like profitability, investment leverage, analyse dispersion, which can be a competitor of ESG dispersion, and hopefully the finding is strong and there. We do find a negative relation between returns and ESG uncertainty. Whenever we control for the ESG rating times the low ESG uncertainty bucket, we do find the negative relation that we have documented in the previous table. Okay? Now, from an investor standpoint, when you say that the riskiness, the perceived riskiness augmented, it makes sense at the aggregate level to think of the market variance. It's as if the market variance is higher due to the ESG uncertainty. But what about stocks? We know that the right way to measure riskiness of stocks is not the variance, but rather the beta. So, to confirm at the stock level that also there we do observe an augmented riskiness due to ESG uncertainty, we looked at the relationship between the CAPM beta of the stocks and ESG rating as well as ESG uncertainty. First of all, you have seen during the COVID, but even before, many people have talked about the idea that ESG is a buffer in times of market turmoil. Other papers have shown that even if it is borderline, there may be a negative relation between ESG and beta. That is, stocks which are well rated in terms of ESG, we probably tend to experience a lower beta because they are perceived as less risky by investors. In fact, that's exactly what we see in this table, but when you control and when you do not control for ESG uncertainty, we see that the phenomenon is stronger when ESG uncertainty is low. So what do we have in this table? In this table, let's look at the low ESG uncertainty case. Think of it as if there is no uncertainty about ESG profile. There, brown stocks have a beta of 1.29, and green stocks have a beta of 1.04. Okay? That's exactly roughly what people believe in the academia and I guess in the industry also about the relationship between ESG rating and the beta. The long minus high spread is 0.249. Okay? So the brown stocks have a beta higher by 0.249 relative to green stocks, and it is statistically significant. Okay? So brown stocks are perceived as more risky than green stocks. However, the size of the spread is reduced dramatically when you condition on ESG uncertainty. You see that the size goes from roughly 0.25 to 0.09, okay, divided by 3/4, okay? So brown stocks are still seen as more risky than green stocks, but to a much lower extent when there is a high ESG uncertainty. Okay, so all in all, what did we do in this paper and what are our conclusions? Our objective in this paper was to look at the puzzle, which is clear-cut theoretical prediction of a negative relationship between ESG and alpha, and mixed findings empirically as to the relationship between ESG and alpha. Our point in this paper is just to say that ESG uncertainty, divergence about ESG rating, may be one possible source of this mixed finding that we find in the literature. So, two main takeaways. First one, ESG uncertainty reduces socially responsible investment. Institutional ownership is reduced between roughly 6% due to ESG uncertainty. ESG uncertainty commands a risk premium, and we have seen that the ESG alpha for brown stocks is 40 basis points. It goes to zero when there is ESG uncertainty. Thank you very much.
Thank you very much, Abraham, for the presentation. So I will just make a couple of comments on the paper, and I guess you can reply to those comments, and after that we can open up for questions. So I just wanted to highlight really that clearly this question of uncertainty is an important one. It's almost surprising that it has been overlooked, right? So it makes obvious sense that uncertainty should be considered. By looking at ESG uncertainty, I think we get interesting new insights really relative to the what we know about the ESG premium. And so as Abraham explained very clearly, that there's very strong economic argument that basically ESG leaders should underperform, right? Because you get in a way compensated through these non-pecuniary benefits. You want to hold the ESG leaders, and so the theory is very clear. Now, evidence is not so clear, and there's essentially two reasons for that. So first reason is that over time, the taste for ESG, if you will, the intensity of ESG preferences can change. So this has been emphasized by a paper by Lubos Pastor, where they basically show that if investors start to care more about ESG, that, for example, could generate some performance in the short term, and that will then, if you will, mess up the evidence that we get from looking at relatively short time periods. We're not going to be able to observe something that looks like the long-term premium. So that's like the first reason why we may not find things in the data that correspond to this clear theory. And then the second reason, which is what the authors show here, is that, well, there may just be uncertainty with respect to this rating, and if you will, that uncertainty could reduce also this underperformance of the ESG leaders, right? So in principle, ESG leaders should underperform, but if there's just a lot of uncertainty over, who really is an ESG leader, then that again could lead to this mixed evidence. So I think it's a very important explanation of these of this mixed findings, and uncertainty clearly plays a role here. What I think is also very nice about the paper is that it emphasizes that actually ESG investors face trade-offs, and it kind of extends the how we look at this trade-off. So again, going back to the well-known theory, the trade-off is basically between the financial returns that you get from a stock and the non-pecuniary benefits. So ESG leaders may align better with your values. You may hope to have some impact. So that's a benefit to you. That raises your utility. So you should not expect, if you tilt to these stocks, you just cannot expect that you're also going to get at the same time higher financial returns. That would be too good to be true. That, there should be, if markets are somewhat competitive, there should be a trade-off in the end. And here I think what this paper does is kind of extends that idea of the trade-off. And so the trade-off now looks a little different. So basically, if you really care about ESG objectives, you need not only high ESG stocks, ESG leaders, you actually need those that also have low rating uncertainty, right? So that you can actually express your ESG preferences well. And so what the paper shows is basically that these high ESG stocks with low rating uncertainty, they come with this trade-off that, yes, they're great from an ESG perspective, but they should be costly in terms of giving up some financial performance. So we get, I think, also better understanding of this trade-off from this paper. I would also emphasize that the conclusions are very practically relevant and very strong. So just a few points here. First of all, what I think is really actually important is that what the authors use here are the actual ratings that everyone is using in practice, right? So they are the ratings providers, the big ones that investors actually use to invest. And I think that's a real benefit over some academic papers which analyze some kind of ESG proxy, which actually, you could argue is really not close to things that people would actually use in practice. So you have a literature on sin stocks, for example. You have a literature also on things like employee satisfaction, with lists of what are the companies that employees like to work for. So any ESG provider would argue that their ratings are not just about identifying sin stocks as ESG laggards. Much more goes into these ratings, and this is what investors use. So I think it's really important also that the evidence here is based on the ratings that people actually use. I think that's an advantage over much of or at least some of the literature. Also, what I think is very important is that the results in the end provide an aggregate view across the ratings providers. So of course the authors use different rating providers to get an idea of the uncertainty by looking at the dispersion. But also, even if you just look at, if you will, kind of the simple ESG strategies that they look at here, like the high ESG ratings versus low ESG ratings, they look on aggregate. It reflects kind of an average across rating providers. And that also means that these conclusions do not depend on a single data provider. And I'm always a bit doubtful when I see papers on ESG that come to very definite conclusions, but they only rely on a single data provider. So my question is, well, those are your findings with that data provider, but they could be completely different with a different data provider. So I think it's a very strong point that here you get an aggregate view. And finally, the conclusions are very strong also because we have both the theory and the evidence. So I think, Abraham, you focused a lot more on the evidence, but for those who want to go to the paper and really look at the details on the theory, I think it's very important to have this economic mechanism actually by which you get these impacts of rating uncertainty, and so we clearly see the mechanism behind this role of ratings uncertainty. Even the evidence is quite rich, so we don't only get evidence on returns, but there's also corroborating evidence on the institutional holdings. So there's a very clear mechanism that actually explains these findings. And again, I think that's a plus. So I mentioned, for example, the role of taste shifts. So on the role of taste shifts, for example, there's a kind of very thorough description in a theory paper, but they're completely silent on the evidence and how you would actually look at this question in the data. So I think having both theory and evidence makes the conclusions particularly strong. I also want to emphasize that the results that the paper presents are really contrary to popular beliefs in the industry. So obviously there's different beliefs in the industry. Different people will hold different beliefs. But I think there are two claims, at least from providers, that are quite popular, and they clearly are refuted by the results in this paper. The first one is that the ESG industry quite often sees ESG as a source of outperformance. So we've seen that theory clearly suggests that should not be the case, and the results here are also very clear-cut. So we have results that the ESG leaders actually underperform the ESG laggards by about 0.5% per month, which, you can look at statistical significance, but also economically speaking, 50 basis points per month is clearly economically meaningful. And so that again shows that, investing into ESG leaders, if they also have low uncertainty, does come with a financial cost, and that's, completely questions some claims that we see that, you can somehow generate outperformance by investing into ESG leaders. Another interesting point is that there are also claims by ESG providers who argue that, this problem with the lack of common standards is not really a problem. So things are actually not that bad. There's good standards. I've seen, recently attended a webinar where the provider claimed that it's just some myth that there could be a lack of common standards. Well, if you look at the evidence presented in the paper, ratings for the same stock are clearly dispersed across providers. So this correlation is something like 0.5, which clearly is shockingly low. If you look at other things like how do different providers classify stocks into sectors, or how do they classify them into countries, you'd expect to find correlation around, say, 0.9. And here, clearly, there is a problem with dispersion across providers, and the paper shows very clearly that this uncertainty about the true rating also has bad economic consequences for investors. And so, again, if you're listening to popular beliefs in the ESG industry and then you read this paper, you probably should be somewhat questioning these common beliefs. So the key idea, I think, behind this paper of focusing on uncertainty, I think is a really strong one. So as the saying goes, nothing is certain except for the uncertainty. And so it's kind of obvious that uncertainty should play a major role, and it would just not be reasonable to think that any provider gives you the true view on what is the ESG performance of a company. And so it's very sensible to look at uncertainty. Also, uncertainty is at the heart of analyzing financial decisions, right? It's all about decision making under uncertainty. So we should definitely account explicitly for this uncertainty. And so I just have maybe a few practical questions with respect to that. I think that the paper looks really at, if you will, the asset pricing implications, but there could be, I think, many other implications. I think this is a really interesting question. So, for example, if you want to have impact or you want to engage with companies, again, if you want to engage with companies, you should think about the objective rating, ESG rating, but you're going to engage about some specific aspect of social or environmental performance. There's going to be some uncertainty with respect to that objective. So does that reduce the efficacy of engagement, and how can you deal with that? And also another question, I think, is what actually drives that ESG uncertainty, and could you think about maybe managing it? So one question is just at the level of ratings, does that uncertainty come from variable selection choices? Does it just come from measurement error? Or does it come from the weighting decisions? So one idea of these ESG ratings, some of them try to weight the criteria by some consideration of materiality. Obviously, there's uncertainty with respect to what is material. And so maybe, could be an interesting avenue to try to disentangle these different drivers of uncertainty. Another question is replicability. So are these ESG ratings actually replicable, and could the possibility to make them replicable, so that if even third parties could go and look at the same company and in principle come up with the same rating, would that be a means of reducing uncertainty, or maybe a means also of making standards converge more? Because once you have things that are replicable, you can criticize them externally, and that could lead to some convergence. And finally, should ESG providers also be transparent about the degree of the ratings uncertainty? So here in the paper, there's a proxy for uncertainty, which is basically the dispersion across providers, but each provider could also acknowledge that certain ratings are more uncertain than others. And just like when you look at a weather forecast, right, the weather forecast doesn't just tell you it's going to be sunny or it's going to rain. It also gives you some probabilities, and that helps you to make your decision, right? If I'm being told it's going to rain, but it's quite uncertain, I'm going to behave differently from it's going to rain, and that's pretty sure on that given day. And so I think it's also a role for providers to think about, can they do a better job at providing information about uncertainty. So thank you very much. I don't know if Abraham and the others, do you want to comment on this?
No, thank you. You summarized on my side, it's okay. Thank you.
So then we can turn to questions from the audience. So what I'll do is I'll just look at your questions and I'll try to put them to the authors. So there's one question which I thought was interesting. So related to the meta-analysis. So the question is, so Professor Liu said that there's mixed evidence from these meta-analyses about alpha, but there's some ESG meta-analysis that argue that 80 to 90% positive correlation between ESG and things like fundamentals and market returns. So could you recommend a meta-analysis that shows these mixed results? Or more generally, can you comment on this idea that there's really mixed results, while there seem to be some meta-analysis that argue that there's clearly positive results?
Yeah, so of course I'll be happy to send some references by mail, but there is a caution with the meta-analysis. Don't forget that there is a super well-known publication bias. That is, if you come with a no result or negative result, it's always complicated to publish. So, for example, when you find 80, 90%, I never saw this number. 60%, I did see this number. But 60%, when you know that there is a publication bias, for me, it doesn't make the case for a positive relation. Moreover, when you look at this meta-analysis, and when you see that they split between the value versus portfolio approaches, the portfolio approaches are much less optimistic than the value approaches, okay? So if the alpha you're talking about is about the portfolio approaches, there is a consensus in the meta-analysis that the worst evidence for a possible relationship between ESG and return is when authors have been using portfolios, okay? So, but I'll be happy to send you a few references if you send me an email. Thank you.
Okay, thank you, Aram. So another question I go to is, so from Ilya Chilomiansky. Our own research has shown that over the year 2020, ESG leaders outperform ESG laggards. Do you think this is a short-term effect, or rather a shift in ESG preferences?
Yeah, so that's exactly the point. So our paper, like other papers, are kind of equilibrium steady state findings, right? So in the long run, as you said, Felix, it's very unlikely that ESG will be a source of performance, and ESG uncertainty is likely to be a source of risk premium. However, there is a transitory path, and this transitory path is impacted by the supply and demand. So yeah, I won't be surprised that for this singular year 2020, you can observe, yeah, I won't be surprised. Because of as we have seen in the very beginning of the presentation, we see a surge in ESG interest and ESG investing interest. So we are likely in a transition period, but we are targeting more the medium and the long term, which our very long sample provide evidence for.
Okay, thank you. So a question on, for example, climate change risk. So this is from Alexander Walford. So the question is, so why is the assumption that ESG considerations are necessarily non-pecuniary? For example, that would be difficult to argue for climate change risk. So can you comment on that? What would be the role of things like climate change risk?
Yeah, so clearly, and we are working on this right now, our model doesn't modelize neither the cash flows nor the risks, okay? But it's clear that ESG in general and climate risk in particular will have an impact may have an impact on cash flows. So we need a more sophisticated model, okay, to apprehend this interaction between the potential positive impact on the cash flow versus the negative impact on the discount rate. And the mix of the two can also be a source of mixed finding today, okay? But our model doesn't do this right now. Okay, but yeah, clearly the pecuniary impact for the firms is probably to be taken into account, okay? But this doesn't contradict the fact that people will get some non-pecuniary benefit from greenness, right?
Okay, thank you. So maybe I will just take a last question. I think we're almost through with time. And then we will, for those questions that we were not able to answer, we will follow up after the webinar. So just one last question. So this is from Jim Biz. So the question is, putting aside issues of having sufficient data for statistical power, do you think the findings would have been different if the data had been divided into two time periods, an early period and a later period, say from 2015?
Oh, definitely. Yes, that's a super point, obviously. So luckily in our panel data analysis, correct me if I'm wrong, I think we do some clustering at the yearly level or something like that. But clearly we are very likely to see some variation through time, in particular because the tests also have changed. Okay, so one way to take into account the dynamic nature of the green premium is probably very challenging, and we didn't address it here in this paper. But this is clearly a super challenging question that require a model plus a serious empirical analysis. Definitely, that's a very good point, of course.
Very good. Thank you for your answers, Abraham. Thank you to the audience for questions. So this concludes the webinar. Thank you for attending today, and have a good day. Thank you very much.
Thank you.